All right, future CPAs, welcome back. So today we're going to tackle two budgets that, let's be real, can be a real headache: direct labor and manufacturing overhead. But here's the deal. We're not just going to learn this stuff. Nope, we're going to build a legit mental model, a framework that's going to lock this into your brain so it's still there, totally clear when you're sitting for that exam in a few years. Sound good? Okay, let's jump right in. So here's our game plan for this session. First up, we're going to set up our CPA brain builder. Then it's straight into the direct labor formula. After that, we'll crack the code on manufacturing overhead and then tie it all together with the all-important overhead rate. And we'll wrap up with a quick-fire bullet review to make sure it all sticks. Let's do this. Okay, let's kick things off with the actual secret to mastering this whole topic. Seriously, this isn't just about passing the next quiz, it's about making sure you own this knowledge for the long haul. And this is the real challenge, isn't it? You learn so much stuff as an accounting student, but how on earth do you keep it fresh for the board exams years later? Well, the key is not memorizing every single table in your textbook. It's about simplifying the logic so you can rebuild it from scratch anytime you need to. And this is how we're going to do it. For this entire chunk of the master budget, you really only need to get two things down. For direct labor, it's just one simple formula. And for manufacturing overhead, it's all about adopting a variable versus fixed mindset. That is it. Let's build out that first piece right now. So let's get into our first building block. We're starting with direct labor, because honestly, it's a super straightforward, just plug in the numbers kind of calculation. Nice and easy. This right here, this is the one and only formula you need for your direct labor budget. It's just three logical pieces you multiply together. How many things do we need to make? How long does each one take? And what do we pay our people per hour? Let's put some numbers to it. Okay, so see how that formula comes to life here. We've got our required production. Based on that, we figure out we need a grand total of 5,600 labor hours. Pretty simple. Then you just take those hours, multiply them by the direct labor cost, which is $15 an hour, and boom, your total direct labor cost is $84,000. See? Units times time times rate. All right, one piece of our framework is officially down. Now, let's move on to the second part. It's time to crack the code on manufacturing overhead. Now, listen, don't think of this as some huge, scary list of expenses you have to memorize. Just think of it as sorting costs into two buckets. That's it. First, just a quick reminder of what we're talking about. Manufacturing overhead, or MOH, is basically every single cost inside the factory that is not direct materials or direct labor. You know, the electricity, the factory manager's salary, the rent for the building, all that good stuff that keeps the lights on. Now here is the mindset. Every one of those overhead costs, it falls into one of these two categories. Variable costs go up and down with your activity level. The more you make, the more you spend. Fixed costs, on the other hand, just stay the same. Your factory rent doesn't care if you had a busy month or a slow one. Getting this difference is absolutely everything. And check this out. Here's that mindset in action. To get our variable overhead, we take our labor hours, those 5,600 hours from the last budget, and multiply by the $4 variable rate. That gives us $22,400. Then we just add our fixed overhead, a flat $60,600. Put them together, and our total manufacturing overhead is $83,000. But wait, there is a classic exam trick hidden in that fixed cost number. See, tucked away inside that $60,600 of fixed overhead is this number, $15,000. And that amount is for depreciation expense. And here is the question you absolutely have to ask yourself, especially when you're thinking about a cash budget. Yeah, depreciation is an expense. It lowers your net income, for sure. But are you actually writing a check to someone for depreciation? No way. It's a non-cash expense, and you can bet the board exams love to test if you know the difference. So to figure out how much cash actually leaves the building for overhead, it's super simple. You start with your total MOH, that's the $83,000, and you just back out that non-cash depreciation of $15,000. That leaves you with the real cash going out the door, $68,000. Always be on the lookout for depreciation. Okay, so we've budgeted our labor costs, we've budgeted our overhead costs, but now we need to build the golden link that connects all of this to the actual cost of our products. And that link is the predetermined overhead rate. So what is this thing? Well, the POHR, as it's called, is basically an estimate we calculate before the year even starts. We use it to spread out or apply all those overhead costs to the stuff we're going to make. It's our best guess of what overhead will cost for each unit of activity. And the formula is super straightforward. You just take your total estimated overhead for the whole year, and you divide it by whatever your estimated activity is, which a lot of the time is direct labor hours, just like in our examples. This gives you one single rate to use for the entire year. For our example company, when you take their total estimated overhead for the year, that's $404,000, and divide it by their total estimated labor hours of $40,400, you get a nice, clean, predetermined overhead rate of exactly $10 per direct labor hour. So why do we care so much about this one number? Why is it the golden link? Because this $10 rate, you're going to use it for pretty much everything else. It's how you calculate the cost of your products, how you value inventory on your balance sheet, and even how you figure out the cost of goods sold on your income statement. If you master this one rate, you've just connected this budget to like half a dozen other topics you're going to see on the exam. Okay, we have covered a ton of ground. So it's time for our high-energy, rapid-fire LEPA bullet review to really burn these concepts into your long-term memory. You ready? Let's go. First step, the direct labor budget. What is it? It's one simple formula. Units to produce times the time per unit times the rate per hour. Got it? Units, time, rate. Number 2, the manufacturing overhead budget. Don't you dare memorize a list of accounts. Just sort them. It's always your variable costs plus your fixed costs. That's the mindset. And third, your pro tip for the exam, your study hack. If the question is about cash, you go on a hunt for depreciation and you subtract it from your total overhead. Remember, it's an expense, but it is not cash. So now you've got this. You can calculate these factory costs no problem. But here's a final thought to chew on. How do you go from being the accountant who just prepares the budget to the manager who actually uses it? How would you use these numbers to control costs, to spot problems before they get big, and to actually motivate your team to hit their goals? That's when budgeting becomes a real superpower. Thanks for tuning in.